So in this video, I'm going to be talking about making money with trading, and I'd also like to share with you a Google Sheet that I actually created and programmed that can help you analyze stocks and then help you make money in trading. But first of all, in order to make money with trading, we need to understand intraday variation. Now, if you are already knowledgeable in trading, you might know some of what I'm about to do here, but you should still stick around because you probably haven't seen a Google Sheet like this one that I've put together. So I'd like to show you that Google Sheet. And then if you're new to trading, then I think you'll find this presentation helpful in understanding the basics that you need in order to do trading. All right. Now, first of all, I'd like to quickly explain trading versus investing, because I realize that people who are new to stocks, completely new, don't always understand the difference. So investing actually refers to purchasing and holding stock over a longer period of time. And I say longer because it's relative. So that could be years, right? For instance, it could even be potentially decades, right? Such as in retirement funds or something like that, right? Trading, on the other hand, refers to purchasing and selling stocks over shorter periods of time. So that could be a period of days, or some might even consider it to be over a period of weeks. But basically, it's purchasing and selling, right, over shorter periods of time. Now, day trading specifically refers to buying and selling the same stocks within the same day. And the purpose of doing this is to maximize profit in a shorter period of time, right? Trying to make more profit, more return in a shorter time within that same day, right? And that's pretty much the same point of doing trading as well. All right. Now, the thing is, we need to know and understand the 4 price points that exist within a stock market trading day. So first of all, the first one of these 4 price points is open. Okay, the open. The open is the price when the market opens at 9:30 a.m. in the morning. The close is the price when the market closes at 4 o'clock p.m. All right, so very simple. Whatever the price of the stock is when it opens, that particular stock, that's its open price. Whatever price it is when the market closes at 4, that's the close price. Now the low is the lowest price of the day, and then the high is the highest price of the day. So the low and the high, they do not have a particular time. They can happen at any point in the day between 9:30 a.m. and 4 o'clock p.m. We don't know when they're going to happen. They can just happen anytime, right? Now, I did put together a really super simple, very much non-technical diagram just to give you an idea or kind of a visual on these 4 price points, right? And for instance, this could be the open all the way on the left. We think of time from left to right, and that is the way that charts are drawn anyway. And so over time from left to right, the market opens, the stock is at a particular price here, and then this arrow represents that it drops down to a low price, rises then to a high price, and then drops down somewhat and finishes here at a closing price at the end of the day. Now, it doesn't have to be in this particular shape, though. It's not always going to be that, it's going to hit the low and then hit the high and then drop down. It's not always in this order, right? There are different shapes or ways that it could unfold during the day, but this is just kind of an ideal shape, right? If I were trading, right, it would give me the chance to let the market open, to see the price drop, to buy it potentially at the low, and to sell it at or potentially close to the high, right? Okay, and that's basically how you make money in trading, right? And it doesn't have to be all in one day. For instance, you could buy something down close to the low today, and then tomorrow you could sell it close to the high on the next day, which might end up being even higher than today. So you might make even more money holding it into the next day, right? So that's just the general idea of how you make money in trading. A very, very non-technical explanation, right? Okay, so basically, just to bring that home, you're trying to buy around the low and you're trying to sell maybe somewhere around the high. Buy at a low price, sell at a high price. Buy low, sell high. Now, for this Google Sheet. Now, this Google Sheet, this is really my focus. I'm a spreadsheet programmer. This is what I really do. I have a lot of spreadsheets I've made for e-commerce, and now I'm getting more into doing some for the stock market as well, right? So basically, the way this works is you type a symbol in, any symbol, and right now I have the Apple symbol here, AAPL, stock symbol, stock ticker, and it will automatically pull in the company name and the price, okay, the last price, recorded price of that stock, right? This should be the close price, the price that it closed at today, all right? Then you will enter in the number of days in the past that you want to look at. I typically, a lot of times, like to look at 1 year, but you could also do 6 months. But by putting a 365 in here, right, it's then going to look at the last 365 days. Today's September 1st, 2022, and it looks back to September 1st, 2021. All right, this is telling you the number of trading days that exist within these days. Because remember, the market is closed on Saturday and Sunday, and then also on certain holidays. So even though it's 365 days, it's only 252 days or trading days. And this is just the estimated number of trading weeks. It's not a real calculation of it, but we assume that there's about 5 days or so in a trading week. So somewhere around 50 trading weeks, okay? And that's basically what this is about, okay? Giving you an idea of, so the stock symbol, the price, the last price of it, right? And this is the length of time that we're looking at, all right, which you get to decide on this, okay? You can put a different number. You can put 180, and it will only give you the last 6 months. And I'll show you the top of this part down here that you see the first date is now March 7th, right? First trading day, all right, 2022. But when I put 365, you'll see that the first trading day September 1st, 1 year ago. Okay, now so I'm going to just now explain what this is down here, right? I use Google Finance. Google Finance is a function of Google Sheets where you can pull stock data, but you have to know how to program it, right? So what I did is I pulled in all the dates, right? And it also pulls in all the open prices, the lows, the highs, and the close prices. So you can actually go down, you can actually see day by day what these open, low, high, and close prices were all the way, okay, throughout the history, right? And here I added my own Excel formula. This is not Google Finance. My own formula, which tells you the day of the week. It figures out what day of the week each of these dates are, okay? So this was a Wednesday, this was a Thursday, or Friday. So we can kind of see, get an idea of when these weeks were starting and ending. So this is when Monday, this was a Monday, for instance, right? Now, looking at these at a glance, we do see these prices in here, open, low, high, and close, the 4 price points. But they're just a bunch of numbers if we just kind of look at it at a glance, right? Doesn't really tell us a whole lot, right, to really just look at these numbers. So there's some different things that I have calculated here that we should look at. And there's a lot here, but I'm going to tell you exactly what to look at, right? One thing you can look at is the 4-point average. 4-point average is just simply the average of these 4 price points on each day. So rather than looking at 4 prices at once, you could consider looking at one at a time to get an idea of how it progressed, right, from day to day, right? They can just kind of give you a little visual idea just looking at the data, right? We can see prices in 140s here. We can see more prices were in the 150s here. So it looks like it was kind of like it got lower here than it was here, right? But really what I would like to really focus on with this is the intraday variation. So I'm going to skip some of this, although this is stuff you should know too. But I'm going to skip that because the focus of this video is intraday variation. So intraday variation means variation or change in price inside of the day. Okay, between the 4 points inside of the day, right? So the range, which is the low to high, is the distance in price, the distance between the prices, or how far apart the low price of the day is, the low price compared to the high price of the day, right? So if this was $1 and then this is $1.50, right? They're 50 cents apart, right? But actually, it's calculated as a percentage, right? So actually, what you would say is, well, $1.50, right, is 50% higher than a dollar, right? Because 50 cents is half of a dollar. So you would say, well, it was 50% in that case, right? That would be a big jump, by the way, if you went from a dollar to $1.50. Sounds small, but percentage-wise, that would be 50%, okay? So that would be very big, okay? But rather, okay, we see with a stock like Apple, a more common range would be the numbers we see here, like 1.7, okay, or even 4.5 would be even kind of high for Apple, right? We see these different numbers. We can go through and just kind of look and get an idea of the numbers. But actually, if we really want to get a good overall idea of the range, the low to high of Apple, we can just go up here and look where I have summarized the average, the min, and the max. Why did I do this? I did this so that we can look at one number immediately and get a general idea of the range of this stock. And we see that the average range is 2.47%. Okay? If you are not experienced and you have not looked at a lot of different stocks, that might not mean anything to you. But if you know stocks, you know that this is a relatively small range compared to what's out there, right? This is the minimum or the smallest range Apple has ever had in the past year, at least. Not in the whole history of Apple, but in the past year, past 365 days, 0.84% was the minimum range, and 7.14% is the maximum. It's the highest range it has ever reached in the past 365 days, right? So what range is very important, because what it means basically is that if you were to take one of these days, say this day, I'll just take a random day, 2.83% was the range on this particular day. So what that means is that if you bought Apple at the low on that day, and then you sold it, and let's use visuals, we bought Apple here at the low of that day, and then we sold it at its high of that same day, you would have earned 2.83% return on your investment. So if you put in $100, you would come back out with 102, basically almost 100 and well, you'd get $2.83 on top of that. So you'd have $102.83. Okay, almost $103. Right? That's what it means. Okay, 2.83% increase. And of course, the more money that goes in, the bigger those numbers get. Right? Now, basically, that's fine. But now in trading, well, let me do this. Let me show you the difference. Now, keep in mind the numbers. Okay, the range numbers for Apple. Okay, the average, min, and max. Keep in mind the share price for Apple, which is almost 160, right? About 158. Now I want to show you another stock called Gevo, G-E-V-O. And the company is literally called Gevo. And look how, first of all, the share price. Okay, the price of one share of this stock is only $2.86, so it's very small. It's way smaller than Apple, right? So that's the first thing I want you to see. Okay, this is what we call a penny stock. Not surprisingly, because the price is so small, right? But look at the difference in the stats for the range. Look at the average. The average is 8.37%. Remember, Apple was only 2 and change. Look at the minimum. The lowest it has ever been for the past 365 days is 2.9%. That is the smallest, I should say, that the range has ever been. The smallest gap it has ever had between the low and the high for the past year, the smallest gap it has had, is basically 3%. The smallest. The largest is 36.5. So imagine if on that day that it was 36.5, if you had bought Gevo close to the low and then sold it close to the high, you would have earned a whopping 36.5%, or maybe 36% on your investment. Now, what ends up actually happening, however, is that things don't go quite that perfectly. So you usually, I mean, like I said, we don't know when the low is. We don't know when the high is. We don't know exactly when it's going to happen, right? We can guess things. There are things that people can do to kind of, guess and try to gauge what it's going to be. So maybe you wouldn't get it exactly there. Maybe you would get it here, a little bit above the low. And maybe you wouldn't be sell the high. Maybe you would sell here. But even if so, even if you did that, you still might have come out with 20% on that day, right? So this is the idea of how you make money in trading. Okay, this is the concept, right? So, which is what I wanted to explain in this video. So this is how this Google Sheet's going to help you. How it's going to help you is you can look at a stock and you can gauge the potential based on the normal intraday variation that exists in the stock, right? Meaning the distance between price points, right? So even if you look at the numbers of the range, you can see how large these numbers are. You've got 14.66% on this particular day. You've got 16.24% on another, right? So you've got like all these huge numbers. I mean, normal, and it's regular. It's not like an unusual thing. It's all the time. 14.85%, 12.26%, right? 21.51%, 28.65% here. It's constant. 13, 11, 10, 18, 17.8. Okay, 19.35. All right. Very large numbers. When you see 5, it looks very small, doesn't it? Right? Because now you've gotten used to seeing all these double digits. Right. Okay. So this is the idea of how you make money in trading. Right. This is how. This is the data. This data is showing you how. Right. And another thing I should have pointed out with this is that when you click this view button, it will actually show you the stock on Robinhood. All right, and I'm not signed into mine right now. But even when you're not signed in, you can see the chart. Now, I do have a link, or should have a link in the description of this video if you want to sign up. Go ahead and sign up, create an account, even if you don't trade, even if it's just to sign up and look at things. But I would suggest even, if you haven't traded yet, you can start with any, as small an amount as you want, basically. And there's lots of stuff on YouTube actually teaching people how to trade. And this video, I'm not really teaching how to trade, and I'm not an expert trader. I've just been in it maybe a couple years myself. But my thing is really analysis, numerical analysis, specifically programming spreadsheets because I'm a programmer. And so this is what I can bring to you. And you can then go and learn more about the actual trading part and see how you can utilize this combined with some other things you can learn. And all of that together can help you potentially make some money in trading. Right? And that is basically the idea. So looking at the chart, you can look, for instance, at today's chart. Right? And not every day is going to be a winning day. But you can just see, like the range, right? Okay, and then you can look at a week, and you can see how the price has moved over the course of a week, right? You can look at a month, see how it's moved over a month. You can look at 3 months and see how it's moved, right? You can look at a year, and imagine that you're looking at this chart for the year, and it just looks like a chart, but just looking at this chart, you cannot see any of this, right? So it's interesting, right? It's here. All of what we see here, all of these ranges and all of this stuff, right? These prices, maybe I might refer to these prices because the chart is basically showing you the closing prices, right? But it just looks like something that's moving up and down, right? So what the numerical analysis brings is a little more detail on some numerical things that are happening, right? And then the chart brings you something else. Because with the chart, there's certain things that you can see better, right? Visual things, right? You can see how steeply things are dropping or climbing, right? And there are lots of techniques that are taught for how to interpret these charts, right? So basically, putting all of this different information together that you're going to get out there and learn, get a copy of this Google Sheet as well. And there's more to this Google Sheet, but I don't want to overburden you with too much in this one video. This is more just of an introductory video to the concept of intraday variation and how it helps you to make money in trading. But I will have more videos explaining and going into a little more detail on how I do analysis using this Google Sheet and how you can possibly use that in some way to help you with trading and to make some money in the stock market. So anyway, I'm Mr. Mark, and if you like the video, then like it. If you want to subscribe, definitely subscribe and try to stay with me. I do have contact information that should be provided. Like I said, get a copy of this Google Sheet. Pop in some symbols if you're already trading. Pop in some of the stocks that you currently trade. See, what some of these numbers give you. There's a whole nother section of this Google Sheet which does some day of the week analysis, which I will have to explain because there's a whole bunch to go with that. And I will explain that as well in another video. So anyway, thanks for watching. I hope to hear from you or see you around on the channel.